The fluorescent glow of the kitchen light cast long shadows as Sarah meticulously sorted receipts. Across the table, Ben stared blankly at the tax software, a single bead of sweat trickling down his temple. It was tax night, and for years, their routine was simple: input their W-2s, take the standard deduction, and sigh with relief. But this year was different. A new house, unexpected medical bills, and a significant charitable donation had thrown their familiar process into disarray. The question loomed: were they making a costly mistake by sticking to the standard deduction? This year, that familiar routine felt like a gamble. Sarah knew their financial landscape had shifted, but the alternative, itemizing deductions, seemed like navigating a labyrinth designed by the IRS itself. Ben, ever the pragmatist, just wanted the path of least resistance. Yet, the nagging suspicion persisted: could they be leaving thousands of dollars on the table? This isn't just their story, it's a financial quandary faced by millions of taxpayers every single year. The choice between standard and itemized deductions is rarely straightforward, and often misunderstood. Today, we're cutting through that confusion. We'll delve into the common misconceptions, the hidden truths, and the precise moments when one choice dramatically outweighs the other. Our goal is to empower you with the knowledge to make informed decisions, transforming tax season from a dreaded chore into an opportunity for significant savings. We'll follow Sarah and Ben's journey, revealing how a few key life changes can flip the script entirely, guiding them to a moment of clarity that changed their approach to taxes forever. Let's begin with the familiar, the standard deduction. At its core, it's a fixed dollar amount that taxpayers can subtract from their adjusted gross income, AGI, reducing their taxable income. It's the simplest option, requiring no documentation of individual expenses. According to the IRS, it's designed to provide a baseline reduction for all taxpayers, regardless of their specific outlays. For many, its appeal lies precisely in this simplicity, offering a straightforward path through the complexities of tax season without the need to track every last expense. The vast majority of American taxpayers opt for the standard deduction. Recent IRS data from the 2022 tax year reveals that over 87% of individual tax returns utilized this option. This figure underscores its widespread appeal, largely driven by its ease of use and the fact that for many households, their total qualifying itemized expenses simply don't exceed the standard deduction amount. For these individuals, the standard deduction offers a convenient and often optimal way to reduce their tax burden without extensive record keeping. The actual dollar amount of the standard deduction varies significantly based on your filing status. For the 2024 tax year, a single filer or those married filing separately can claim a standard deduction of $14,600. Married couples filing jointly see a doubled amount at $29,200. Heads of household fall in between, at $21,900. These figures, adjusted annually for inflation, represent the critical benchmark against which itemized deductions must be compared. If your itemized expenses don't surpass these thresholds, the standard deduction is typically your best bet. For Sarah and Ben, married filing jointly, the $29,200 standard deduction had always been a reassuring constant. It meant less paperwork, less stress, and less time spent poring over complex tax code. This preference for simplicity isn't unique, it's a common psychological driver. As Dr. Emily Clark, a behavioral economist, notes, the cognitive load associated with financial decisions often leads individuals to prefer defaults and simpler options, even if they might not be the most optimized. For years, this cognitive ease had steered their tax strategy. However, simplicity can come at a cost. While the standard deduction saves time, it can inadvertently lead to missed opportunities for substantial tax savings. This is particularly true for individuals or couples whose financial lives evolve. Major life events, such as buying a home, incurring significant medical expenses, or making large charitable contributions, can quickly push a taxpayer's potential itemized deductions far above the standard amount. The choice, then, is not just about ease, but about maximizing financial efficiency, a factor often overlooked until it's too late. Now, let's turn to the other side of the coin, itemized deductions. Unlike the standard deduction's fixed amount, itemizing allows taxpayers to subtract specific, eligible expenses from their AGI. This approach aims to provide a more tailored reduction based on actual out-of-pocket costs. However, it demands meticulous record-keeping and a thorough understanding of what expenses qualify. For many, it remains an enigma, perceived as overly complex and reserved for an elite few, a perception we intend to challenge. One of the most pervasive myths surrounding itemized deductions is that they are simply too complicated for the average person to manage. This belief often deters taxpayers from even exploring the option. While it's true that itemizing requires more documentation, modern tax software and readily available resources have significantly simplified the process. Financial experts, like CPA Michael Lee, often argue that the perceived complexity is far greater than the actual effort required, especially with today's digital tools. This perception is a major barrier to potential savings. Another common misconception is that itemizing deductions is exclusively for the wealthy, those with vast investment portfolios or multiple properties. While it's true that high-income earners may have more opportunities for complex deductions, this doesn't mean middle-income families are excluded. In fact, significant life events, regardless of income level, can trigger a scenario where itemizing becomes highly beneficial. A 2023 analysis by the Tax Policy Center indicated that a substantial portion of itemizers are not in the top income brackets, challenging this persistent myth. So, what exactly can you itemize? The IRS allows deductions for several key categories. These primarily include state and local taxes, often referred to as SALT, with a current cap of $10,000 per household. Mortgage interest paid on a primary residence is another significant deduction. Unreimbursed medical expenses exceeding a certain percentage of your adjusted gross income, and qualified charitable contributions to recognized organizations, also play a crucial role. Understanding these core categories is the first step toward assessing your eligibility. For years, Sarah and Ben simply dismissed itemizing. Their rent payments didn't qualify as mortgage interest, and their state and local tax payments alone, primarily income tax, rarely approached the standard deduction's magnitude, even before the $10,000 SALT cap became a significant factor. Regular medical expenses were covered by insurance, and their occasional charitable donations were modest. They fit the profile of the vast majority of taxpayers for whom the standard deduction was indeed the simpler, more logical, and more beneficial choice. Their tax software consistently reinforced this decision. In previous years, after inputting their income and a handful of basic deductions, the software would quickly recommend the standard deduction, often displaying a clear message: your itemized deductions total less than your standard deduction. Choose standard for maximum benefit. This seemingly definitive guidance further solidified their belief that itemizing was simply not for them. It reinforced the default setting, making any further investigation feel unnecessary and overly burdensome. Then came the pivotal moment. Last spring, Sarah and Ben bought their first home. The excitement of homeownership was quickly followed by the realities of property taxes, closing costs, and, most importantly, mortgage interest payments. This single event dramatically altered their financial landscape and, unknowingly at the time, their tax calculus. It introduced a new dimension to their deductions, forcing them to reconsider assumptions that had guided their tax filing for over a decade. This wasn't just a lifestyle change, it was a financial pivot point. Mortgage interest is often the largest single deduction for many homeowners. In their first year of homeownership, Sarah and Ben paid approximately $15,000 in mortgage interest alone. This amount, combined with property taxes, represented a substantial increase in their potential deductions. The IRS allows taxpayers to deduct interest paid on a mortgage of up to $750,000 for married couples filing jointly. This deduction alone can push many homeowners past the standard deduction threshold, making itemizing the more financially prudent option. Beyond mortgage interest, their property tax bill added another significant sum. Sarah and Ben paid $6,000 in property taxes. However, it's crucial to remember the state and local tax, or SALT, cap. This federal limitation restricts the deduction of state and local income, sales, and property taxes to a maximum of $10,000 per household annually. Even though their total property taxes and state income taxes combined might exceed $10,000, they could only deduct up to that capped amount. This cap significantly impacts high-tax states. Adding another layer of complexity, Ben faced an unexpected medical procedure mid-year, resulting in substantial out-of-pocket costs not fully covered by insurance. They tallied nearly $12,000 in qualifying medical expenses. For medical expenses to be deductible, they must exceed 7.5% of your adjusted gross income, AGI. With an AGI of $100,000, their threshold was $7,500. This meant $4,500 of their medical expenses were potentially deductible. This category, often unpredictable, can be a surprising swing factor for many households. Their commitment to community also played a role. Over the year, Sarah and Ben contributed $2,000 to various qualified charities, including their local food bank and a disaster relief fund. Charitable contributions are deductible, provided they are made to qualified organizations and you keep proper records. While this amount might seem modest individually, when combined with other deductions, it contributes to the cumulative total that can make itemizing worthwhile. It highlights how everyday acts of generosity can also have a tangible tax benefit. It's the cumulative effect of these various deductions that often triggers the shift from standard to itemized. For Sarah and Ben, each new expense category, mortgage interest, property taxes, medical bills, and charitable donations, began to build a compelling case. As tax analyst Dr. Evelyn Reed explains, many taxpayers fixate on one large deduction, but it's the sum of all qualifying expenses, even seemingly small ones, that determines the optimal path. The individual pieces, once seen in isolation, now started to form a potentially powerful whole. Despite accumulating these new expenses, Sarah still harbored doubts. The sheer volume of receipts and the perceived complexity of itemizing felt daunting. "It just seems like too much work for possibly no real gain," she confided in Ben. This hesitation is common. The fear of making a mistake or investing time into a process that might not yield a benefit often outweighs the potential for savings. It's a psychological hurdle rooted in past experiences and the ingrained belief that taxes are best kept simple. Ben, for his part, remained skeptical. "We've always done the standard deduction, and it's always worked out," he reasoned. This inertia, the preference for the status quo, is a powerful force in financial decision-making. As financial psychologist Dr. Lena Hansen points out, people often anchor to their past behaviors, assuming they remain optimal, even when external circumstances have drastically changed. This anchoring bias prevented them from fully grasping the magnitude of their new financial landscape. The old way felt safe. The turning point began not with a grand revelation, but with a simple act, entering all their potential deductions into their tax software, line by line, just to see. As Sarah typed in the mortgage interest, then the property taxes, then the medical expenses, a slow realization dawned. The numbers were adding up, quickly approaching their $29,200 standard deduction. The software's running tally became a silent, compelling argument, replacing their assumptions with concrete data. The what if was becoming a what is. Let's directly address the myth that you need a ton of money to itemize. This is demonstrably false. While high-income individuals may indeed have more opportunities, the key factor isn't necessarily your income bracket, but rather the types of significant expenses you incur. A substantial mortgage, large unreimbursed medical costs, or significant charitable giving, regardless of income, can make itemizing beneficial. It's about expense profile, not just income level. Data from the Tax Foundation shows a broad range of AGIs among itemizers. The most fundamental, yet often overlooked, hidden truth about itemizing is the absolute necessity of meticulous record keeping. The IRS requires documentation for every deduction claimed. This means keeping receipts, bank statements, donation acknowledgments, and any other relevant paperwork. Without adequate records, even legitimate expenses are useless for itemizing purposes, warns tax attorney Clara Rodriguez. This isn't just a suggestion, it's a non-negotiable requirement. Digital tools can greatly simplify this process, but the discipline remains vital. Sarah and Ben's experience perfectly illustrates the cumulative effect. Separately, their charitable donations might not have tipped the scale. Their medical expenses, while substantial, needed to clear a threshold. But when combined with the substantial mortgage interest and property taxes, the story changes entirely. This synergy of deductions is often where the real savings are found. It's not about one single, massive expense, but rather how several common expenses can aggregate to surpass the standard deduction threshold. The unanimous advice from financial professionals is clear: never assume. The biggest mistake taxpayers make is defaulting to the standard deduction without running the numbers, states Marcus Chen, a certified financial planner. Your financial situation changes year to year, and your tax strategy should evolve with it. This means dedicating the time, or using reliable software, to calculate both options every single tax season. An assumption of simplicity could lead to significant missed opportunities for savings. Who typically itemizes? While it's true that higher-income households are more likely to itemize due to larger mortgages, property taxes, and charitable contributions, IRS data indicates a surprisingly diverse group. Many itemizers are middle-income families with significant homeownership costs, or individuals who faced unforeseen medical emergencies. It's not an exclusive club defined by wealth, but rather by specific life circumstances and deductible expenditures that push their total past the standard threshold. Let's look at the broader picture. While 87% of taxpayers claim the standard deduction, the remaining 13% who itemize represent a significant portion of the total tax savings. According to the Tax Policy Center, the average itemized deduction in 2022 was roughly $45,000 for married couples filing jointly, significantly higher than the standard deduction. This disparity highlights the potential benefits for those who qualify, underscoring that while fewer people itemize, those who do often see substantial reductions in their taxable income. Modern tax software has revolutionized the deduction decision. Programs like TurboTax or H&R Block automatically calculate both your standard and itemized deductions as you input your information. This removes much of the manual calculation burden and fear of error. For Sarah and Ben, the software became their impartial guide, presenting a clear, data-driven comparison, instantly showing which option yielded a lower tax bill. This accessibility has made what was once a complex accounting task manageable for the average taxpayer. Let's return to Sarah and Ben. Their standard deduction for married filing jointly was $29,200. Now, let's tally their itemized deductions. Their mortgage interest, $15,000. Their property taxes, capped with state income taxes, $10,000. Their qualifying medical expenses, $4,500. And finally, their charitable contributions, $2,000. Each number, meticulously entered, built towards a surprising total, a sum they never anticipated reaching just a year prior. The moment of truth was approaching. The software displayed their itemized total, $31,500. A collective gasp escaped them both. This figure was not only higher than their $29,200 standard deduction but exceeded it by a substantial $2,300. This difference, small as it might seem in isolation, translated directly into a lower taxable income and, critically, a larger tax refund than they would have received by defaulting to the standard deduction. The hidden truth was finally laid bare, quantified in dollars and cents. What did this $2,300 difference mean in real money? Assuming their marginal tax rate was 22%, that $2,300 reduction in taxable income translated to an additional $506 in tax savings. This wasn't just hypothetical, it was tangible money back in their pockets. As financial advisor Dr. Alan Peters notes, even seemingly small deduction differences can compound significantly over years, impacting long-term financial goals. This specific saving underscored the real-world consequence of a seemingly minor tax decision. The financial relief was profound, but the emotional impact was even greater. The anxiety that had clouded their tax night evaporated, replaced by a sense of empowerment. They understood their tax situation in a way they never had before. Sarah felt vindicated for her careful record-keeping, and Ben appreciated the clarity the software provided. They had pulled back the curtain on the enigma of itemized deductions and found not complexity, but opportunity. It was a journey from uncertainty to clear, actionable knowledge. Sarah and Ben's story serves as a critical reminder: your optimal tax strategy is not static. It must be reviewed annually. Major life events, homeownership, marriage, significant medical issues, even substantial charitable giving can dramatically alter your deduction landscape. What was optimal last year may not be optimal this year, advises tax specialist Brenda Lopez. It's not a one-time decision, but an annual assessment that could yield significant returns. Always reevaluate your situation, regardless of prior choices. Understanding the interplay between the standard and itemized deductions is a fundamental pillar of personal finance. It transforms tax season from a dreaded compliance exercise into an annual financial health check. By probing beyond assumptions, keeping diligent records, and utilizing available tools, you gain control over your tax obligations and uncover potential savings. This knowledge empowers you to not just file your taxes, but to truly optimize them, ensuring you keep more of your hard-earned money. The experience of Sarah and Ben is a powerful testament: don't leave money on the table. The difference between the standard and itemized deduction isn't just about avoiding a few lines of paperwork, it's about making an informed financial decision that can save you hundreds, even thousands, of dollars. Invest the time to understand your options. Your financial future, and your next tax refund, might thank you for it. Empower yourself with knowledge, and take charge of your tax destiny.